Thank you for tuning in to this edition of the Vulcan Report for trading on January the 27th, Wednesday, 2016. Today is Fed Day, so the markets are probably going to be relatively tame, still trading within the very tight trading range that we've seen. We're trading inside of last week's bar here as indicated on the weekly chart. Market's trying to take a run at the resistance high of 1907 and a half here on the S&P 500 futures chart that you're looking at. As you can see, trading volume is a little light ahead of the Fed statement. Market's neutral, not a lot going on. And I wanted to also give you the heads up that we are definitely in a bear market here as all three moving averages are trading lower. Okay, prices are trading below all three averages in addition to that, and gaining, moving lower. Downside momentum is gathering here. I suspect all rallies will be met with selling, and that's just whatever happens with the Fed. Fed really has nothing to do with the overall direction of the market. The market's going to go where it's going to go. Every Fed stimulus going back to 2000 and 2001, really 2000s were really kicked off. About around March of 2000, that's when the Fed started lowering interest rates in between meetings and without any kind of warning, and they would just constantly shock the market. And when I mean shock the market, I mean movements of 600 points in the Dow instantaneously. It would overwhelm the Globex servers. They couldn't even keep up with all the orders. The S&P would move 110 points. The Nasdaq and the Dow would both move 600 points, respectively, within minutes, within 2 minutes. Prices would just jump all over. It was bananas. Since then, the markets have calmed a lot over the years, minus the few flash crashes that we've seen. Most notably, May the 6th of 2010. If you missed that, you can go into my archive videos here on YouTube. It's there. That's like one of my most famous videos. I actually recorded it live as the flash crash was happening, so you can see what's what. Uh, and also, we've had since then flash crashes in gold and silver. We've had it in crude oil since then. Um, Pretty much across the gambit. We've had it in currencies. So it's been all over the place. Things have just happened. Flash crashes have not stopped, they've increased. Instead of decreasing, they have increased. And it really doesn't take much to cause a flash crash. Sometimes it happens without warning, without any special news to come out. That is a risk that we take in the markets. We're willing to assume and accept those managed risks in return for the rewards. Just like a market can flash crash 1,000 points, it can also crash upwards. It could rally 1,000 points. These things just happen, and you have to be prepared for it. And regardless of what you think the trend or direction of a market is, you should have a strategy in place to take advantage of anything that could pop up in a market. You have to know what you're going to do in a market before you even get in it. So, for those of you who want to play the Fed today, unless you already have a position in place, you probably want to set tight and just see what happens. Regardless of what happens, I don't suspect it to be too violent, because pretty much everything that can be known is already factored into the current price of a market. And they already tried to run it up yesterday ahead of the Fed. So anything that happens today should cause the markets to move a lot lower. And that's just my opinion. As you can see, 1921, I'll say and a half, we'll round it to a half, it's going to be the intraday resistance. and really I would call it the weekly resistance. I do not believe we'll be able to get beyond that, or even close too much beyond that. It would take a lot of money printing from the Fed to do that. They would really need to get the plunge protection team all together across the board in order to make that work. I'm not saying it's impossible. They've done similar things in the past, most notably 9/11. The week after 9/11, when they reopened the markets plunged. The Dow plunged like 1,200, 1,500 points, and then instantly, in a V-shaped recovery on an intraday basis, the market recovered all of its losses. It was a powerful thing. They even engaged in a psyop campaign in the media, telling people that if you shorted the market, you were unpatriotic. Some of you younger people don't recall that, before your time, but for those of you who do recall and you were there in the markets during that time, you know and remember what I'm saying to you is a fact. All right, moving on here. Not too much to see here in the S&P 500. So let's move on to take a look at the Russell. Let's look at the Russell. If you've seen the S&P, you've seen the Dow, so it doesn't matter. All right, here's the Russell. The Russell is a little bit tighter in the trading range. Historically, it does not have as wide as ranges as the S&P, the Dow, and the Nasdaq per se, and that's because it's a bigger monster. It's basically $100 a point versus the S&P at $50 a point, the mini Dow at $5, and the mini Nasdaq at $20 a point. So that's the reason for that. Upside here on the Russell, our weekly resistance that we're looking at is 1039.40, and that's this blue line right here. The next resistance is going to be at 1108, and then finally trend line resistance is 1153.8. Not saying it's impossible. PBT can do whatever they want to do. You've seen the length of these other bars. If you move this bar over to here, that would put us to this white dot here, which is 1128.7. So we could go 100 points easily. That's over, actually a little. That's like 120 points basically from where we are now. Yeah, it can be done. The market's done it before. Again, this bar moved over here will give you that, and it's possible. As you can see, recently we have moved as much in a week. The extent of this bar is 1136.6 on the top and 1039.8 on the bottom, virtually 100 points. So it can happen. Is it likely to happen? I'm going to say no. What else can the Fed do to cause extreme rallies in the market? There's nothing else the Fed can do, unless it says we're going to lower rates. If they lower the rates back down to zero, that might spark some buying. But overall, they're out of bullets. There is nothing else the Fed can do. As we've seen, they've lowered interest rates a million times, and still the market is where it is today. Okay, as I'm doing this video, the new home sales numbers just came out for December, up over 10%. Let me just say this and then I'll leave it alone. Everything you've been told about the real estate industry is a bona fide lie. I should know because I worked in real estate for many years, after the Wall Street gig, and I had my own mortgage company at one point, and I can tell you right now, everything you've been told about that is a lie. The housing market is not better, it's not stronger. Foreclosures are going up, especially in well-to-do gated communities, as the middle class continues to get decimated under this deflationary depression that we've been in for some time now. It's so bad that the Fed is trying to bring back those 100% mortgages with no money down, even some of the no doc type loans. They're desperate. They're trying to do whatever it is they can do to keep this economy from crashing faster than it already is. So just wanted to give you that. Also, the market is took it on the chin since this report has come out. The Dow was down like about 80 points. Now it's down 133 points. Let's pull that up so you can see what I'm talking about. All right, here's your Dow. All right, as you can see, we are gaining downside momentum. Likewise, you can see it's trading below its resistance point 2 of 16,262. Currently, we're at 15,929, and no way I can see, other than the Fed coming in here, I just don't see anything good in the economy to cause the market to push higher. Taking a look now at the precious metals, looking at gold first. As you can see here, nice push. All right. The video that I made a couple days ago telling you it's time to buy silver, it's time to buy the metals. Well, as you can see, the metals are pushing higher. Gold is making a run for its long-term trend line resistance at 1141.10. This orange line right here should be able to break that before the week is out and gets and close somewhere within the cloud will be optimal, because then that'll give us a run toward the top of the Kumo cloud, and we should break out back above 1200. So definitely some power coming up here. All right, breaking up into the resistance range. All right, this should give us a nice push. This should be actually the beginning. This pink purple line here should now act as your trend line support. Before it was your trend line resistance, as we're trading below it. As prices continue to move higher and march toward this orange line here, the blue line should push up above this line, and both lines should make a march up and cross above here, giving us the beginning of a bull market run in the gold. Our long-term support outlook for the gold, we're going 6 to 12 months out. 1200 should be our strong support. Once again, 1200 should be the strong support for the gold going forward if we can manage this, which we should, as long as the Fed continues to do what it's doing. It's actually doing the metals a favor now. All right, because now the man behind the curtain has been exposed. The money printing, now people are starting to slowly come into the realization that it is going to continue to destroy your purchasing power of your dollar, and it's going to make the precious metals more valuable in the long run. All right. Finally, we'll finish up the video in silver. Actually, we got to do crude oil too, so I'll try to hurry up here. Silver also making that push. We can close above this intermediate trend line here of 1445. A close today above 1445 in the front month silver will set us up to march toward the white dot resistance of 1497, and then 1540 at the trend line here respectively. So we should be able to get up to that 1540 in the silver by Friday as well and close above that. We may not get a close into the Kumo cloud, only because we have a little bit, we've suffered more short-term damage than the gold did as far as price destruction, but it is possible. Long-term trendline support for the silver should be $16. All right, and that's within the next six to 12 months. So $16 is going to be your strong support for the silver in the long term. All right. We'll finish up with crude oil now. Here's your crude oil. As you can see, we're trading right now at $30.90 after hitting 27.57. last week. We have a long way to go here. Right now, current trendline resistance is at 32.74. Next resistance is at 38.34, and then 48.21 respectively, which is this orange line here. Long way to go in the crude oil. One thing to note is that the volume is starting to pick up a little bit here. All right, and we'll see which way the market breaks. It's still very weak. We still have much downside room to go. All right, and this thing is just locked in. The downtrend in the crude oil is very pronounced. It is locked in and seeming to accelerate. The 2757 I don't believe is going to hold unless some World War III literally breaks out or something really huge happens. A nuke needs to go off or something in order to cause the crude oil to recover. Let me just say a final note too about crude oil. If you remember back during the 2008 elections, crude oil $150 a barrel, people crying, saying how it's going to destroy the economy, yada, yada, yada. High prices, energy prices, or we can't handle it. And then next thing you know, right, as we know, Obama's about to be elected, crude oil crashes down to $40 a barrel from $150 a barrel. Then since then, it's been going down ever since. And now you have the talking heads saying, "Oh, low oil prices is bad for the economy." Well, wait, hold on. You just said that high oil prices were bad for the economy, and that when the prices go lower, it's basically a stimulus to the economy and to the American people. Now you're saying it's bad. So high oil prices is bad. Low oil prices is bad. It's ridiculous. The talking heads on Wall Street don't know what they're talking about. They don't know what they're doing. They couldn't trade their way out of a paper bag. That's why they don't. They create the systems and mechanisms so that they can get paid for every trade that you and I do. That's how they make their money, by being able to cheat the system that they have created. And we don't complain. We know they manipulate. And we don't complain because without them, there'll be no market to trade. So we get it. But trading, they don't do. They really don't. Not in the sense that you and I do. When we have a losing trade, we have to eat it. When they have a losing trade, they get to bust those tickets, and they don't exist. That's why they can have, they can go 10 years without a losing trade because they get to bust them. All right, that's how that works. Anyway, this video has gone way over more than I wanted it to, but I had to pretty much redo everything since my technical difficulties on the other videos was pretty substantial. The videos were cutting off at like 4 minutes and 25 seconds. So hopefully you've heard and seen enough in this video to understand what we're doing for the rest of the week. All right. So remember, take what you can, give nothing back, be encouraged, and have a wonderful FOMC day.